Welcome to the March 2023 monthly MOTR Checkup. My name is Dave Lundgren. I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. The title of this month's video is You Might Break the Bank, but Not the Bull. I think this is an important moment in the inflection of trend. It's not uncommon to see an early developing new bull cycle get tested by a lot of bad news and headlines that are prone to drive a lot of volatility, but not necessarily derail what's going on in the evolution of trend reversal. And it's all about the news that's coming out match the headlines corresponding to all the data that the market was already responding to throughout the course of the previous bear market. So we'll talk a little bit more about that, but here are your disclosures, your favorite part of the video. So just to summarize what we're going to talk about here. So you might break the bank, but not the bull. So the question I ask is, are the FTX and SVB bankruptcies, and perhaps more to come, are they what the last year's bear market was all about? And so if so, from here, the headlines could potentially get worse as the Fed needs to do this, the Fed needs to do that, global central banks, et cetera. More companies go bankrupt, maybe even non-bank related as it relates to sort of tangential knock-on effects of the what's happening in the banking space. But the idea is that the whole bear market from last year, that's what the bear market was all about. And it was telling you that these things were coming. So now that they're hitting the headlines, it's actually quite common for the market to just continue to rally through that wall of worry, if you will. It's perverse, it's frustrating, it's confusing, but at the end of the day, that is a hallmark of bull markets, especially early on. So something to think about. Let's see here. So prior to the SVB bankruptcy, as I've been highlighting in prior videos, as well as in the weekly notes, the conditions were steadily improving, and we saw a lot of cyclical leadership, et cetera, and none of that's really changed. And most importantly, as of now, that the S&P is still holding above that 3,800 support that I've been highlighting actually since I think it's November. But the 3,800 support is still intact despite the second largest bank failure in U.S. history. That's a point that probably should not go unnoticed. So although as a consequence of all this new heightened volatility and in the response to the markets digesting this news and investors kind of trying to think about what to do, it's obviously creating a lot of volatility. And in our process, we have very strict risk controls ranging from getting stopped out of positions, obviously, if trends reverse, or if volatility expands, it automatically forces us to contract the size of the positions that we have. So as a consequence of that, we have taken down our risk exposures overall, but we still don't have any short exposure on because we still believe we're in the beginning stages of a new cyclical bull market. It's just a period of pause, and so therefore we take down exposures. In the meantime, we are laser focused on emerging leadership. And in that regard, as I highlighted in last week's weekly MOTR report, we're noticing that IT is continuing to gain. It's now in the top half, displacing energy, which has continued to fall. So we've been repeatedly highlighting the idea that we've been lowering our energy exposure over the past couple of months for a number of reasons, all of which actually we've highlighted in our notes. And with that, and then with this most recent decline or setback in the market, the energy sector has now actually fallen off the top half, and that's the first time in over almost 2 years actually. So let's talk about what we have going on from a headlines perspective. So what I've done is I've gone back to the early 1980s, and I've highlighted all of the major bankruptcies that we've experienced since the early 1980s. And what we notice is that these large bankruptcies don't actually cause bear markets to start. What I find is that they either happen during an ongoing bear market. 9 out of the 25 bankruptcies that I highlight here have actually happened while a bear market was ongoing, and those are marked with red arrows. And then we also have the uh, the the remaining bankruptcies that actually happened during the either the very early stages of a new bull market or well into an established bull market. So the point being that is as these bankruptcies are made known, they've either happened in the throes of an already ongoing bear market, which is likely what the bear market was all about when it first began. So again, the bear market starts, you're a year or two into it, and then the bankruptcies become known. So that's one scenario, and there's only 9 of the 25. The remaining are actually bankruptcies that are major, significant bankruptcies that happen during the early stages of a bull market, if not a little bit later on in, and they don't derail the new bull market, and that's the whole point. The bear market was about these impending bankruptcies. So when they happen, the market's already processed them vis-a-vis the bear market that happened. But of course, there's a lot of volatility surrounding that because investors are responding to the headlines. So the point to take away here is that nearly 2/3 of these major bankruptcies have actually happened during bull markets and did not derail the bull market. So the obvious question for us to ponder here now is the most recent bankruptcy, Silicon Valley, does that deserve a red arrow indicating that it's a bear market bankruptcy, or is it a green arrow, as I have it marked, indicating that it's a bankruptcy in the very early stages of a new bull market? So we already know that that I've detailed many reasons for why I think we're in the early stages of a new cyclical bull market, and I think if you think about if that's my thesis, as I've mentioned, my stop on that thesis for a number of months now has been holding above 3,800. So as long as we can hold above 3,800, I want to just continue to give the benefit of the doubt to the bulls, particularly given that the leadership as it stands is still quite cyclical. So as long as that's the case, I want to assume that we are in the early stages of a new bull market, and I want to assume that this bankruptcy from Silicon Valley is a bankruptcy in the early stages of a new bull market. And so all it will do is create volatility, but it will not derail or terminate this bull market. So this is more or less a philosophical question, but why might bankruptcies be bullish? But it's something to think about. The only thing I can come up with is that they tend to incite the Fed to liquefy the system, and it's like a call to action for the Fed, and so they therefore liquefy the system, and stocks, of course, love that. That's the lifeblood of the stock market, liquidity. So when the Fed is stirred into action and maybe has to reverse course on their current policy or accelerate their ongoing policy, which was the case in the early 2009s. Maybe that's the reason. It's just it stirs the Fed into action, creates a wall of liquidity, and away we go. But at the same time, we have all these headlines that continue to come out, building this wall of worry, and of course the market loves that too. So you put these two things together, where you have Fed liquidity coupled with a wall of worry, and historically that's been fodder for a new bull market. So until we get below 3,800 with a rotation away from cyclicals and all the things I've been talking about, I'm of the mind that we're still in a new cyclical bull market. Let's just quickly cover what happened with Silicon Valley, or Silly Valley, as I used to refer to it back in the day. Silicon Valley has been an avoid in our work since 2021. So you can see the trend line break here, relative performance break here. So from a trend following relative performance perspective, which is our process, we haven't been interested in owning this stock in quite a while. And more broadly speaking, if you look at financials or banks in particular, they've been underperforming since back in 2005 and 6. So with the banking index going out to new highs with the broader market, this is when you got your first bearish relative performance divergence, which was your first warning that at minimum you want to be underweight financials. Of course, it didn't necessarily give you the warning that the global financial crisis was forthcoming, but you don't need to know that. This is the setup. Just understand that there are better opportunities than financials, and so you rotate to there. And then, of course, later to find out that it was because of an impending global financial crisis. But nonetheless, the point is that the the banks in particular have been underperforming ever since then. And what's important, we hear a lot of people saying that you can't really have a bull market without banks leading the way. And I just don't think that's accurate. What I think is more important is that banks, excuse me here, as I is that the banks at least don't go in a downtrend. So as long as they're in an uptrend, that's the most important thing. We clearly have that here. They don't necessarily have to lead, but as long as they're not a donut hole and they're not in a downtrend, I think that's adequate for a backdrop for a bull market to take place. And so as you can see here, there's still a series of higher lows here, lots of volatility to be sure, but nonetheless, they're still at least not in a downtrend. Obviously, we have some individual names that are like Credit Suisse going below $2 today, but by and large, this is what the banking index in the U.S. looks like. And as long as it's not a donut hole, I think the market should be fine with it. And none of this is sneaking up on the market. The market's known this for 17 years or so. So, okay. So before I really get into the meat of what I'm looking at, I want to just kind of walk you through what I consider to be sort of an idealized version of a transition from bear to bull. And the reason this is important is because it will help set expectations and understand that even though you might be going through a transition from a bear market to a bull market, it's going to be volatile, it's going to be frustrating. And I wanted to just kind of describe what it might look like or feel like now, so that as we're going through it in the weeks and months ahead, that it's not surprising. I sort of started to allude to this in earlier notes where I talked about, if the market fails at 4,100 to 4,300, which is that resistance band I've had up since I think November or December, don't be surprised if it happens, because this is pretty much where it's supposed to fail and have difficulty. So along those same lines, what else might we expect the market to do and actually permit the market to do within the context of our thesis that the market is transitioning from bear to bull? So to begin, obviously, after a 20% plus decline, which is your definition of a bear market, so into those lows, the reasons for that bear market finally become clear, as crystal clear. Like in the case of the most recent bear market, it's pretty much almost to the day when FTX bottomed. FTX filed bankruptcy or at least the exchange collapsed. That's very close to when Bitcoin bottomed. It's very close to when the market itself bottomed. So what my belief is that last year's bear market was all about these impending bad things. As Warren Buffett likes to say, when the tide goes out, we all discover who's been swimming with no clothes. And so that's what this is all about. So the tide goes out, and then we realize, FTX is insolvent. SBNY, SIVB, these are all banks that are having difficulty. So, and I believe that that's what the bear market was all about. And now that we're starting to discover why the bear market happened, don't you know it, the market rallies violently. And so I've talked a lot about this concept of a momentum crash. Whenever you hear the phrase momentum crash, it's really bad for the momentum factor, but it's very bullish for the stock market. So we got a very severe momentum factor crash in November. I wrote about it in my notes, talking about how this could be the very beginning of what could be a new cyclical bull market. And I think since then, we just had more and more evidence in support of that thesis. And so the idea, though, is that when you get this momentum crash, the initial buying, this initial phase of buying, is not super confident buying. It's actually really dominated by short covering and timid bulls that maybe they're value driven or whatever, but they don't have a strong conviction in their purchases. So as a consequence of that, they're weak-handed holders, and so they can be shaken out of their positions, and so that just promotes volatility. And so what you can end up with is, as the news worsens, the market rolls over and corrects even more deeply, and you might even get an undercut low. You might go so far as to retest the lows. We haven't done that yet, of course, but these are all within the framework of what a transition from a bear market to a bull market could and should look like. This is kind of what they look like when you go back in history. So as a result of all this information and news, of course, the Fed responds if it hasn't responded already. Yet the news worsens still. It even gets worse. So that wall of worry just gets built by more and more bricks. And so this is the foundation upon which this new bull market is built. So even as the news continues to worsen, the market finds its stability, and just kind of goes through this process. And throughout this stabilization back and forth process, it can be, this, what I refer to as phase two, can take several months after that momentum crash. So it's kind of like a two-phase process. You have the momentum crash that marks the low, and then you have this period of, could be several months. And during this period, this is when the market is identifying future leadership for the next bull cycle. And I believe this is what we're going through right now. And so as a consequence of further identifying that I kind of was of the mind that maybe the phase two would be a bit shorter, but it strikes me, obviously, given the most recent data, that maybe it's going to be a little bit more prolonged. So I've taken down exposures, I've taken down risk, but ultimately I'm not derailed from my view that we're in this phase two process, and that it will eventually give way to the trend finally reversing into phase three, which can actually still happen, even though the news is still quite negative, especially in the early stages of that phase three. And then from there, of course, we're not there yet, so I won't talk a lot about it yet. But these corrections after phase three gets underway, they're much shallower, they're much quicker because the confidence is restored. People understand why the market's going up, and so for that reason, they're just much quicker, swifter affairs. But this is what I want you to think about as we're kind of walking through these ideas, and have just a sense of understanding for what you should be expecting in the market as we kind of go forward, so that as this volatility takes place, you don't get derailed from what I consider to still be a good thesis, a working thesis for continued strength in the market as the year progresses. Volatility aside, of course. Okay, so I've shown this chart in the past, but I just want to quickly show it once again, because it is true that I've been highlighting these levels for several months, but that's actually the value of it. These are the levels that have mattered since November for sure. And the idea is that we're in this phase two, and 41 to 4,300 should be resistance. And if we're still in a trending environment, which I think is the case off that October bottom, then we're going to want to see that 3,800, the bottom of that 3,800 area, hold up as support, because that gives us our higher low against which we can define and measure an uptrend. If it should happen that that 3,800 does give way, it doesn't necessarily derail the basing thesis. It just prolongs it even further. I think that we would still be fine. We get that undercut low that I demonstrated earlier. We get that undercut low, but I think as long as we can hold above 36.75 to 37.75, that's what I would consider to be base support. So right now, 38 to 3,900, I consider that to be trend support, because off the lows, we're still trending because we have a higher low. If we don't hold at 3,800, then it does take into question the cyclical bottoming process, but I'm not really going to quite abandon it until we actually have evidence that the downtrend is back underway, which would, at least in one part, be evidenced by taking out 36 to 36.75 as a support level. Okay, so if we take a look at the risk gauges, focusing first here, this is the risk gauge for the entire market. Obviously, we've taken a lot of damage on the risk gauges, but what's really important is that the risk gauges are all mixed. None of them are bearish yet. And mixed means exactly that, it's mixed. And so that doesn't mean it's bullish or bearish. And so this is kind of where it should be for phase two. So I'm not at this point, I'm not really put off by the fact that we've kind of abandoned some of the earlier progress we made in the risk gauges, but we do certainly want to avoid getting into risk off. And as of right now, we have not achieved risk off in any of the 4 time frames. So in 2 of them, we are in risk off. Excuse me, just hovering just above risk off at 7. That's the daily and quarterly. But again, as long as we hold above, I'm still thinking of the mind that we're in that phase 2 scenario. The weekly and the monthly are still in the top half, which I think is really important. So those 2 timeframes have not abandoned their momentum profile yet. So again, just stepping back and looking at all these together in terms of the overall market, it's mixed, and that's exactly where we should be. We should be not surprised to see the risk gauges mixed. More important than that is that when you dig beneath the surface and you start looking at the individual sectors, industrials and consumer discretionary, are still number one and number two. That's super important. We have seen industrials get down to 7, so that's taken on quite a bit of water, but it's not risk off yet. And frankly, given that these two here are still in risk on and this here is in the top half, I'd actually be a little bit open to the idea of this getting into risk off, and it wouldn't derail my thesis. What's most important is that industrials and discretionary are leadership. This is really important as well. Technology has derailed energy in the top 5. So I think this is a super positive development for a number of reasons, and we're actually starting to see some nascent leadership potential coming from those mega cap names, which I'll feature in a moment. This is a little bit of a problem, not quite sure what to make of this yet, other than to say that, if indeed we still are in stage or phase 2 of this sort of bottoming process, then allowing for one defensive sector to slip back into leadership for temporary purposes is I'm willing to give it the room and not make too much of it right now, given how everything else is so cyclically oriented. Then when you go to the bottom ranked sectors, you see energy is in the bottom half for the first time in well over a year, might even be 2 years. 5 of the 6 bottom sectors do have their daily timeframes in risk off. So again, this is a message that I've been harping on for a while, that the sectors that are not in the top leadership, they're still kind of too bearish to indicate that the market's ready for prime time. So it's not that it's necessarily at all the death knell for the bull market thesis. It's just that it just shows you that this is what phase 2 looks like. Even once we're in phase 3 in the bull market's well underway, even these bottom ranked sectors will look a lot better on the risk gauges. But the fact that they're not there yet, and not only are they not there, they're actually in risk off on the daily time frame, just shows you that we still have some work to do. So for this reason, we have our risk budget down and our exposures down. Something interesting quietly sneaking in here is the communications and media. Despite all of this weakness we've been seeing, is this sector is quietly creeping up there as well. It's still 10 on the ranking, so it's definitely not something to jump up and down about yet. But it is interesting to note that despite all this noise and what's happening in the broader underperforming sectors, that communications and media is actually holding in there fairly well, and I've got some ideas for you. So overall, just taking a look at this, it's neutral at best, which is exactly where it should be in phase 2. I'm not concerned about what I see here. I need to see 3,800 hold, and I'll show you that there are actually some indices that are making progress as well that we can use as hallmarks as we move forward as well. But by and large, I think the thesis is still playing out, and the fact that we're holding above 3,800, despite the fact that we've had the second largest bank failure in history, is probably enough information for us to make that assessment. But still, nonetheless, when you drill beneath the surface at the sector level, and instead you look at industries, again, if the market was truly concerned about what it saw in the future, which I think is what the whole trend following philosophy is about, the wisdom of the market, it's just really hard to believe that all of these cyclically oriented industries within these cyclical sectors would be still commanding leadership. So this is the top quintile of industries, and it's the who's who of cyclical leadership. Home builders are at the top, lots of industrials, technology, semiconductors are making their way up into the top ranking. So again, if the market was worried about what it sees in the future, I just don't think it would be configured this way. So I think this is an encouraging sign. So something to take a look at as well from a tactical perspective, and the question being, how is that oversold or higher low thesis working out? It's still intact. You can see that the low is still in place. There's that 3,800 level I've been harping on. So the low itself is still intact. Currently, in the past couple of days, we've noted that only just about 5% of the S&P 500 was above its 20-day average. So that's a very low compressed number, and it's oftentimes historically good enough for a bounce, even in a bear market. So when you look at all these other instances of getting that oversold, even in a bear market, you tend to get a bounce from this reading. Now, obviously, not all of them worked in the final throes of that that collapse in the market into the October bottom. Obviously, that one particular instance didn't work, but let's not forget that was a pretty hairy bear market. So, but even under most conditions, you get some sort of a bounce from this very oversold condition. And what's more important and most important right now is that currently we're not really seeing any damage being done. So this is the net number of 52-week highs minus 52-week lows, and we're not seeing any price or chart damage being done, which kind of corroborates that idea that 3,800 is still holding. And just to give you a flavor for what the future might look like, if I am indeed right about the market transitioning from cyclical bear to bull, this is what the indicator looks like, because it also gets this oversold in bull markets as well. But this is the type of response that you can look forward to in a bull market with no chart damage being done during those pullbacks. And so if this is indeed a oversold low in the beginning of a new uptrend, then it should hold there. And that's actually the important point, is that it should hold here. If everything is fine, it should hold at 3,800. So if it doesn't hold at 3,800, then my former boss at Technical Data used to say, Joel Marver, he used to say that if what you expect to happen isn't happening, the opposite is happening. And so I think that's fair here. I think if 3,800 doesn't hold, despite the fact that we're this oversold, and given how it typically responds in bull markets and even in bear markets, and if we don't hold despite this oversold condition, there's probably something happening in the opposite. So again, for this reason, we've taken down our exposures, we've taken down our risk budgets, et cetera. But our belief is that in time, in the next several months, we'll work through this and 3,800 will hold. But we want to be mindful of the potential meaning if the 3,800 doesn't hold. Okay, so I've shown this kind of a chart on the S&P and the mid caps as well, but I thought given what we're seeing more recently with the NASDAQ and how it's really come around from a leadership perspective, I wanted to show you the same analysis on the NASDAQ so you could have the levels handy. But this is your primary resistance. This is phase 2 unfolding. This is your bear market. This is your initial rally off the bottom here. Off the bottom here. This is the beginning of your phase 2. So you should anticipate that this will provide ample resistance for the next several weeks, if not months. While that's happening, we just need to make sure that this trend support holds up. So that's 11,400 on the NASDAQ. Notice that the 50-day is just crossing the slowly turning 200-day moving average. This is all part of that checklist of trend change that I referred to in the past. And so this is actually starting to behave as well as the other indices. And it's actually been behaving rather well despite the second largest bankruptcy in US banking history. So let's keep making that point so we don't forget that. But you can't ignore this progress that we're seeing here. So we all know that tech broke down in the latter part of 2021, which was sort of like the coffin in the grave for, the nail in the coffin for the whole tech space, crypto, all these things had already been breaking down. And this was sort of like the last thing to break down, the NASDAQ, because it was being held up by some larger cap names. So when that broke down, of course, the relative performance broke down with it and ushered in the broader bear market that we, of course, are all too well familiar with from 2022. And this is what the most recent, so you just take that same exact process and turn it on its head. You can't call this anything other than a trend reversal. And what's really, I think, important about this is that as the NASDAQ has pulled back with the broader market, look at what the relative performance has done down here. It's actually gone out to new highs. So, if you go back and read my notes and look at prior videos, you'll hear me talk about the idea that it's conceivable that the NASDAQ bottoms, but it doesn't outperform. We have to keep an open mind. I know that when the market bottomed in 2003, technology outperformed into 2004, but then went on to underperform until the bottom of the global financial crisis. So maybe this is just a reflex rally. They get you a period of outperformance, but not a durable, long-lasting outperformance. We'll see. But this is what we have to work with right now, and I think it's worth highlighting and potentially making some adjustments to by looking at some of those larger cap names as well. I've already mentioned that it's was either last week's note or the week before, that you can actually get overweight technology because there are so many ideas to buy there without owning any of those mega cap names. So that's already a working thesis. But the fact that this is now breaking out relative performance, largely as a function of what's happening in those mega cap names. It's potentially the case now that we can entertain owning some of those as well, and I'll highlight some for you. So if this is indeed the case that technology is taking on a leadership role in the near term here, we're going to want to see a meaningful degree of separation between price and the 40-week moving average. As I said in one of my previous notes and videos, in the beginning of a new bull market, you want the market to get very overbought. In fact, the more overbought, the better. And you want people talking about how it's the most overbought it's been in over 2 years, and so therefore it's the best sell signal. It's actually not. It's actually, when you get that overbought after a bear market, it's actually a buy signal. And so you can see that playing out here a few times. So here's the last 3 big bear markets. This is the dot-com bubble. This is the global financial crisis. This is the bubble unwind, I should say, the global financial crisis and COVID. And you can see all 3 of these. And when they bottomed, notice how far above the 40-week moving average the index became. So this is sort of achieving that degree of separation that just reveals a very strong momentum underpinning the move. And as you can see, we haven't seen that yet. But again, we're in phase 2. We're going to want to see this as we start to embark on phase 3. We're going to want to see some pretty excessive momentum in the tech space to indicate that it is indeed durable leadership, particularly on the large cap, from a large cap perspective. Interestingly enough, I showed you how the relative performance is breaking out to new highs on the Nasdaq, even as the new recent highs, even as the price itself is pulling back. What we're seeing here is this is the XLK relative to the S&P. So using that same concept, how far is the relative performance getting away from its own 40-week relative moving average trend? You can see it hits similar extremes at new accelerations in trend. And we're actually getting close to doing that from a relative perspective. So something we'll want to keep an eye on. There's a potential that I already think you can be overweight tech, using small and mid cap names, but you might actually be able to broaden that out with some of these mega cap names as well. So along that line, I wanted to just highlight a series of names across discretionary, technology, and media. And so when I did this, you can see that just in this screening process, which I'll explain in a moment, the vast majority of them were tech. That's pretty much that's pretty much what you'd want to see if indeed there's a broad participation in this new potential leadership from technology. So this list contains stocks from the top decile of market cap across the 2,500 stocks that I follow. They're all from discretionary, tech, and communications and media, just kind of rounding out that theme that these are potential. This is a potential new leadership area. We already know discretionary is, but with technology, and I mentioned earlier that communications and media has also been weathering the storm rather well. That could be an early indication that during this phase 2 that the market's trying to tell us that this is potential leadership for the new bull cycle. So let's take a look at some of the ideas there as well. And so again, as a final cut to make this list, the MOTR rank had to be at least 50. So you can see that here. So what we ended up with is a broad mix of established leadership and potential new leadership. And so take a look at the list, maybe screenshot this from the video, and you can see them. I can also happy to send this to you, or perhaps I'll include it in this week's weekly MOTR report as one of my slides. But nonetheless, I thought I'd feature 3 of them just to kind of give you a sense from each sector of what we're looking at here. So you can see all 3 of these have broken the downtrends. We have Uber, Shop, and Meta, and you can see them here on the table: Uber, Shopify, and Meta. You can see the breaking the trends, breaking the downtrends rather strongly. You can see that whole phase 2 process taking place here. This is obviously a V bottom. Not the first time, by the way, that Meta has V bottomed, to the surprise of many. Lots of layoffs going on here, and the stock is going straight up. So that's probably enough information for us to make a decision here. But you look at the relative performance across the board here. So you can see these are all very early potential new leadership candidates, and they're all very large companies. So worth taking a look at these for sure, as well as the remaining stocks on the list I showed earlier. So I want to just highlight a couple of charts that I think might be worth keeping an eye on as well as the year progresses as potential problems for the cyclical bull thesis that I'm putting forth here. So despite falling nearly 30% off its highs, um, during that decline, as we all know, stocks outperform bonds, which is a very rare instance. I mean, I don't think it's ever happened in history where the stock market's dropped 30% and outperformed the bond market. So that's obviously set up a potential strange relationship between these two asset classes going forward. And what I want to be mindful of is if you start to see new lows in this relationship going forward, it might be that the higher interest rates, should they persist from here, or at least higher inflation, is starting to make its way um, into the relationship between stocks and bonds. And so this is just the S&P divided by the TLT. So this is just stocks relative to bonds prices. And if you start to see some weakness here, it could be an indication that the stock market is finally coming under some pressure as a consequence of higher rates and inflation, more so than the bond market is. And so we already know that that's taken place. That's what largely what a large part of this decline was all about. But as I've shown throughout this whole period in here, despite this bear market, the leadership within the market has been rotating to stocks and sectors that benefit from rising rates and benefit from inflation. So the leadership has indeed been very high interest rate and very inflation sensitive. In other words, they benefit from that. But what might be interesting is to see is that if this relationship starts to break down, do we continue to see rotation into those parts of the market that benefit from that, or does it actually cause the entire market to come unglued, and we actually go through that 3,800 level and resume the bear market? So that's all. We'll cross that bridge when we come to it, but and we'll follow the data one day at a time, one stock at a time. But I think this is a chart worth monitoring as the year progresses. And then another chart that I think is really important is keeping an eye on the U.S. versus the world, ex-U.S. This trend has been in place since the global financial crisis. I've already highlighted this chart a number of times, but it's starting to break down. So, this is kind of a bit in conflict with the discussion I just had about if indeed we are going to see mega cap tech come back into the leadership spot again, then it's kind of hard to believe that U.S. starts to underperform the world, because largely this trend right here is largely due to the fact that large mega cap technology stocks outperform the rest of the world. And so it's a bit of at a crossroads, but this is definitely a chart to keep an eye on as the year progresses, and just keep an eye on this trend. And then lastly, if indeed the 3,800 level does give way on the S&P, which is not my base case, but if it does, I thought it'd be interesting to show a couple of charts that I found on social media that shows just how closely the current market trend is mirroring both the 2000 to 2001 decline, as well as the 1972 to 1974 decline, which you see here. So we're kind of right in that spot where this 3,800 level really needs to hold, and the market needs to stick a landing here. Once again, I'm very encouraged to see the market hold in above 3,800 despite this massive bank filing for bankruptcy. So that you would think that normally that would cause a big whoosh through support. We didn't get that, so that's a good sign. But nonetheless, I thought it'd be interesting to show these charts just to kind of give us a perspective of what might lie ahead should that 3,800 level give way, which again, just to reiterate, is not my base case. Okay, so just to summarize, despite these heightened concerns with all these bankruptcies and potential for more to come, either within the banking sector or in other corporate America that's sort of tangential to the banking sector, it is our base case that the market will power through this. We have 25 examples of massive bankruptcies, 16 of which happened during a bull market and did not derail the bull market. And it's important to note that most of those bull market bankruptcies actually happened at the beginning of bull markets. And so I'm kind of throwing this SVB bankruptcy in that cohort, and so therefore I believe it's it's likely that we'll just power through it. There'll be a lot of volatility. This is phase two, so it's not ready for prime time, but I think ultimately we can work our way higher. So for now, we're staying the course. As I mentioned earlier, reflecting this loss of recent momentum that kind of encouraged us to take on a more full risk position. We've taken that down, taken down our exposures overall, but we don't have any short exposure on because, again, we don't think that that's the environment we're in. It's just more of a timing aspect of what's happening. And ultimately, as this 3,800 level continues to hold, we believe that over the next couple months, weeks to months, our exposures will be rebuilt and the risk budget will be spent once again. In the meantime, as always, we are laser focused on where the market is transitioning to for potential leadership in the upcoming cyclical bull market. I've industrials, discretionary. There's even some materials in there that we can point to. I think energy is kind of fallen by the wayside, so I've cut back that exposure to zero. And the two sectors that I really want to keep an eye on over the next couple months would be technology, which is already something you can be overweight from an equally weighted perspective, but possibility that these mega caps are coming around as well as potential communications and media. So when I say communications and media, I don't actually mean the communications part. I mean more specifically the media part. And so we'll be monitoring that in the weeks ahead to see if we're starting to see any momentum build amongst those newly developing areas of potential leadership. So that's what I have for you for this month. For those of you who can't get enough, here's your disclosures once again. Thanks for listening. And as always, feel free to reach out to me through email or give me a call if I can help out with anything, or if you need a portfolio review or you have any questions. Thanks so much.